All right. For this mock exercise, we're going to take a look at a company called Masui Corporation, and we're going to look at how to account for an asset. So let's take a look at the question. So the question states that this company purchased a machine on September the 3rd, 2009, and they paid a cash price of $93,900. And the following day, it paid $600 for delivery of machine. And I guess the question we need to ask is this part of the capital asset? Is this part of the purchase of the capital asset? Or was this necessary? If it was necessary to get the asset to its intended use, then we have to capitalize that to the cost of the asset. If not, it's an expense. They also bought a 1-year insurance of $975 on the machine that was purchased on September 6th. And again, we need to ask whether this insurance is part of the cost of getting the asset to its intended use, or is it part of the normal operational cost? And in this case, if I look at the delivery, clearly that cost is part of getting the asset to the intended use, to the premises, right, of this company who bought it. But the 1-year insurance, you could see that this is part of what we normally would do for risk management, is do we buy insurance to ensure that our assets are well protected. So this, to me, is an operating expense. Now, on September 20th, we also paid $3,500 for installation and testing the machine. And again, we need to ask, is this part of the cost of getting the asset to its operational use, or is it an operating expense? And in this case, because we're installing and we're testing the machine, then this should be part of the cost of the asset. And we need to capitalize that to the cost of the asset. Now, we bought the asset on September 3rd, but the asset was actually ready for use on September 30th. So the importance of that date is that is the date in which we start the amortization process, the depreciation process. That given the fact that the machine was purchased on the 3rd, and we needed to actually test it, install it, and deliver it, to me, all of these costs incurred in the month of September should be capitalized, with the exception of the insurance policy, and we're going to start depreciating the asset on September 30th. Second paragraph says that the estimated useful life of the machine will be 4 years, or 40,000 units with no residual value. So these information is what we need to calculate the depreciation expense. And assume that the equipment produced the following units per year. So there's 2,500 in 2009. 10,300 in 2010, 9,900 in 2011, 8,800 in 2012, and 8,500 in 2013. And we're told that this company has a December 31st year end. Now, this is important because you'll see that in the year of acquisition, we bought it on September. So we have a short year end, which means that we have to prorate the first year's amortization expense. So the required says, A, determine the cost of the machine. So let's do that. So the cost of the machine, we know it's going to be the cash price, $93,900. We're also going to add to it the delivery cost, and that is $600. And we need to also record the install and testing cost of $3,500, and that's $98,000. And we know that the insurance of $975 is expensed. Okay, now if we were to do a journal entry, our journal entry would be debit machine It's an asset, 98,000, and we're going to credit cash. Presumably, all of these were paid out of cash. And we're also going to debit insurance expense and credit cash. Now, chances are it's probably a prepaid insurance because we haven't used up, right? It's a one-year insurance. And we would have to figure out how much of that insurance relates to how many months in the year. So this one at December 31st, adjusting entry, we need to debit insurance expense and credit prepaid insurance. By the way, this is an asset. And it would be 975 divided by 12 months times how many months? So obviously we bought a one-year insurance on September the 6th. So September, October, November, December, it'd be 4 months. So 975 divided by 12 times 4 gives us 325. So you would debit 325 insurance expense and credit prepaid insurance. Okay, so that's essentially the first part of the required. I just added an extra bit on the first required just to show the journal entry. Now, Part B says we need to calculate the depreciation for the asset over its useful life and using two methods, straight line and units of production. So let's do the first one, straight line. So under the straight line, I'm going to short form that SL. We're going to take, so the annual depreciation is the cost of the asset minus the zero residual value. We're told it was 0. And we're told it's 4 years. So the annual depreciation is $24,500. Now, if we were to figure out the 2009 depreciation, the year of acquisition, the number of months is going to be 3 because we start the amortization in October 1st, September 30th. So you've got October, November, December. And we're going to take the first depreciation expense for the first year. It's only 3 months, and that would be 24,500 divided by 12 times 3 will give us 6125. Okay, and the cumulative depreciation for the December 31st, right, is 6125. In 2010, the depreciation will be the annual rate of 24,500. Sorry. This is 12 months. And the cumulative depreciation is 30,625. It's just adding the 6125 with the 24,500. In 2011, again, we have 12 months of depreciation. And the annual depreciation is 24,500. And the cumulative is 55,125. And in 2012, it's 12 months again. Now in 2013, being our last year, you see that we have 9 months. Because altogether it should only be no more than 4 years, right? And 9 would be 24,500 divided by 12 times 9. It's 18,375. And you'll see that overall the cumulative should be $98,000. Okay, so what's the journal entry? So the journal entry for 2009 And for all the years would be the same journal entry, except the amount obviously will be different depending on which year we're dealing with. But for 2009, the entry is debit depreciation expense, 6125, credit accumulated depreciation. And that would be your entry for 2009. The key takeaway is we have to prorate the first year of depreciation because we've only used up the asset for 3 months. That's the key, is in the year of acquisition, you need to watch for the date of acquisition. In this case, we bought it on September the 3rd, but we didn't physically use the asset on September 30th. So one of the required questions is we needed to decide what the period, when should we amortize. And in this question, they specifically gave us 2 dates. They physically used, ready for use on September 30th, but we bought it on September 3rd. And this is the date of the start of depreciation. It's when the asset is ready for use. Now, we're going to do the other part for Part B. It's asking us for what would the units of production depreciation be. So, under the units of production, I'm going to call that U of P for short. First, we need to calculate the rate. And the rate is going to be exactly the same way we calculated the straight line. So it's cost minus residual value, that's 0. And the denominator is not number of years, it's going to be 40,000 units. Because we're projecting that we're going to consume this asset over producing a production of 40,000 units. So this gives us the rate per unit, which is $2.45 per unit. Now, so when we're doing the units of production, again for 2009, the number of units in 2009 was given to us to be 2,500. In this case, that number's already been prorated because we've only used it for 3 months, and naturally the number of units produced will be much less because it's only for a 3-month period as opposed to a full year. So in this case, there's no additional step, right, of prorating. We're just going to take the 245 times the 2,500, and that gives us 6125. And the cumulative depreciation is 6125 for the first year. Now for 2010, we're told that number of units was 10,300. And we're going to multiply that times 245 to give us 25,235. And for 2011, we're told that it was 9,900 units. Okay, and multiply again by 245, that gives us 24,255. So this method is reflective of what we call a true matching of expense, the use of that asset. So the more we use the equipment, right, the more depreciation we're going to show, we're going to record, and that gives us a true matching of expense to revenue. Because presumably we would use the machine to produce units, products to sell. So this would be a true reflection of matching. For 2012, we're told that we produced 8,800 units. And that, again, times 245 is 21,560. And you add these two to give us 77,175. And for 2013, the last year we used it and we made 8,500 units times 245 is 20,825, and then some of that is 98,000. And again, the entry is going to be debit depreciation expense, and this is for 2009, be 6125, and credit accumulated depreciation 6125. Now, the next part of the question says, assume instead when the corporation purchased the machine, the company had a legal obligation, okay, to ensure that the machine would be recycled at the end of its useful life, and the cost would be significant. Would this impact the answers to A and B above? So what they're asking us is, they're saying that if the company incurs a cost at the end of the useful life, and the cost can be estimated, we have two choices. So this would be the, let's say we call it the asset retirement obligation. So this would be cost at the end of its useful life that we have a obligation. When we retire the asset, we're going to incur some cost. Now, if the cost is significant, what do? We need to present value the estimated cost. Present value because this cost will be incurred at the end of 4 years. So we would present value the estimated cost, okay, and add it to the cost of machine. And by adding it to the cost of the machine means that we're going to debit machine XXX and we're going to credit some sort of long-term obligation. Okay, that would be the entry we would need to do at the date of acquisition to show the obligation at the end of 4 years. And again, if the cost is significant. If the cost is minor, then what do? We adjust the residual value. In other words, we would reduce the residual value for the estimated cost of retirement. So what we'll do is it will impact the depreciation expense by taking down the residual value, and obviously the residual value amount would we, because that residual value is supposed to be the amount that the company expects to get when we dispose of the asset, the cash value at the end of the useful life of the asset. It will automatically be reduced by the obligation to retire the asset. So when you have a question like this, and if there is the retirement obligation of an asset and the amount is significant, you're supposed to record an obligation at the date of when the machine was purchased, as long as that is significant, can be estimated at the time of acquisition, and you present value because the payout is not until 4 years from now. If the cost is minor, then all you need to do is take that estimated cost and net it against the residual value, and that will impact your depreciation. So in either cases, it will definitely impact the depreciation charge each year. Thank you.